Welcome to the Robert Hunt Financial Market Update, where I look at the week's financial news that can be a bit confusing, misleading, and take us off course now to make it actionable, understandable, and clear. What a week. What a show. For all my hot water and lemon enthusiasts, enjoy these last couple cool days in Dallas, Texas in the rain. It's about to get hotter. We've got a great show. 3 articles. We're going to be looking at The Random Path to Stock Market Riches by Spencer Jacab in the Wall Street Journal. This may go down in our year in review episode as one of the greatest articles written. It's that good. So if those of you dig in the show notes and want to read it yourselves, it reinforces so much of what we hold to be true here at the RHF Market Update. Second article, we're going to be looking at the meme stock return. GameStop, AMC, Bloomberg News syndicated this share surge on return. There's a video of a guy, Keith Gill, and all these stocks are popping again. We're going to talk about how to make sense of it. And then in closing, we're going to look at 529 college savings plans. CNBC had an article with, quote, saying 529 plans are better now than they've ever been. We shall see. Make sure you're doing the right thing. But at the top, a candidate already for one of the greatest articles written for the year. Heard on the street, Spencer Jacab, Wall Street Journal, The Random Path to Stock Market Riches, How We Made 80% in a Year Without Really Trying. Right? This article explains. In the investment management business, a whole host of folks are picking stocks for a whole host of reasons. Now, the famed author and Princeton University professor, Mr. Burton Malkiel, some of the listeners here have actually had him as a professor. Amazing. Jealous. Yes, I am. His book, A Random Walk Down Wall Street, came up with an exercise that challenged the established notions of the day about investing. It said that you could have 12 darts. You could post up stock market listings on the wall, have 12 darts. He said you could have blindfolded monkeys throw them. Any of us can throw them. I don't know why Mr. Malkiel was trying to emphasize that skill was not involved. I don't know why the monkeys need to be blindfolded either, but in the event these monkeys could read and understand, he wanted to be sure, blindfolded monkeys. Mr. Malkiel showed, hey, just a random throwing of these darts resulted in results that were indistinguishable from the professionals. And so this author, Spencer Jacab, is recreating that article. So he's recreating an exercise that was done in 2018. He's taking 12 darts, and he's competing against the very best fund managers that are presenting the best idea at this Sohn Investment Conference in New York City. So at this big conference, everyone gets to pick these hedge fund guys and pick their very best idea, and we see what happens. Well, the last time the exercise was done in 2018, the pros lagged behind the dart tosses by 22 percentage points. So this is instructive for us. What happened this time around? So again, this is recreated. This gentleman puts up on the board a bunch of printouts of stocks, a whole host of stocks, and he takes his darts and throws them against. Why do you think he did this time against these experts, these best picks from the Sohn Investment Conference in New York City? That's right, 48% to the good, better than the experts. So some of it, this article explains, not for the faint of heart, because they earned an 80% return throwing these darts randomly. But some of the companies they had never heard of, Maui Land and Pineapple was one of them, and some others did. There's a software company that lost more than 97%. There's another company, NGL Energy Partners, they randomly clicked. It was down a ton and then went up a bunch. It was just all over the place. It was randomness, as Mr. Malkiel was quick to remind us, randomness. But the big takeaway what's the big takeaway for this man, Mr. Spencer Jacob? It was that it's just one winner that contributes to the outperformance typically. Isn't that the case? So the article explains the biggest takeaway from our picks is that while there were a few other winners, a single stock, insurer Root, Inc., was responsible for all of our net gains. That hews to reality. So there was a study, a long-term study of U.S. stocks returns by Hendrik Bessenbinder. That's the last name, Mr. Bessenbinder. Shows that half of all the excess returns come from 83 companies. Half. Now, there might be over 3,000 publicly listed stocks, just 83 of those. So most stocks underperform risk-free investments. Those are treasuries, money markets. So for us, for the listener, what I don't want you to do is listen and say, oh, great. Call your kids over and say, guys, we're going to print out all the publicly listed stocks in the world, put them up on the wall. I want all the children to come around, get your darts out, throw them against. We will put our money in the places where the darts fell, to the long or to the short, depending on where the darts fall, and we're going to outperform. That would not be the application I'm looking for. The application I would be looking for, what I hope is evident to you, would be, wow, this is super hard. 2, a lot of the expertise that we perceive is expertise could just be luck. Okay, so now of course there are going to be Warren Buffetts of the world who you look at and you go, feels like we're dealing with some skill here. But it is my conviction that a great majority of folks that are actively picking these securities are winning or losing by the same reason someone throwing darts against a wall would win or lose. There are just statistical realities to stock selection that will give winners and losers. Now, why can you not roll this strategy out and put it on the road? Because doesn't that happen all the time? All right, let's say they earned 80% this past year, outperformed all the pros. Why can't you get a slide deck together, go to all the pension funds and endowment funds and family offices around the world and say, guys, look at this. I threw darts against the wall and outperformed. You're not going to raise a nickel. But if you go and show that 80% return and you give a very cogent, clear answer that uses language that those gatekeepers of capital are familiar with, like alpha, risk-adjusted return, anomalies, synergies, data. If you use enough words, you actually could raise some money around a fund. Quite a bit of it. So it's a great reminder to us that when you see someone do incredibly well, it could be skill, but we don't know. And what we do know is that random darts can also attribute to outperformance. And let's not get cocky here. And that reminder when I'm talking about just a few securities contributing to the gain, it's another reason why index funds are so helpful and are a bit like an insurance policy. Let's say you didn't have NVIDIA, which is the graphical processing unit design company, that's done so well the past few years. If you just failed to pick that one stock, you would certainly trail the index. It would be almost impossible for you to catch up because so much of the gain in the index can be attributed to NVIDIA doing so well. So look at this article, should time allow, and remember that all that glitters is not gold. Just because you see outperformance doesn't mean it's repeatable or that it's attributable to skill. Next article. This was syndicated by Bloomberg News. I thought this was a great lesson in efficient market theory because it has the potential to challenge it. Okay. Let's get some hot water now down our systems. On this chilly in the 70s day here in Dallas, Texas. Keith Gill, so a little history here. And there was this meme stock craze. I suspect many listeners recall. GameStop and AMC were on these crazy trajectories when people were kind of locked down, kind of had some stimulus checks in their checking account, were bored perhaps. And this gentleman got a following felt cult-like at times. And they would all get in these message rooms and say, hey, let's buy this stock. Let's all go buy this stock. So that happened. Well, guess what? This gentleman came back. He came back. And now, Grapevine-based, just up the road here, home of Great Wolf Lodge. Grapevine-based GameStop shares surged as much as 46% in pre-market trading as speculation swirled around a return to social media by Keith Gill, who drove the meme stock mania of 2021 under the moniker Roaring Kitty. I never quite got that. When I read things like, and this article continues about how when he shows up and tells his followers, let's do this, it famously surged more than 1,600% in January of 2021 when the meme stock frenzy was just going bananas. So I think a lot of his followers are thinking, here we go again. What we must do business with, listener, is, well, Robert, I thought you were an efficient market theorist. I thought you were one of these people that said all available information is priced into a security and therefore there aren't these material inefficiencies available. Well, this is where every philosophy gets pushed. So, in the short run, any sort of movement like this is going to be possible. I'm not calling this manipulation, but it certainly appears as though GameStop and AMC are being detached from their fundamentals. So, just because this guy gets on a screen, is GameStop really worth more than 46%? 46% more than what it was previously before he got on the screen? Why is Mr. Keith Gill showing up on a screen make your company worth 46% more? Doesn't that sound like there's some gross inefficiencies in the market? Yeah, in the short run, you can't. It's going to be tough. I'm an efficient market theorist, to be sure. That means that I believe that all available information is incorporated into the pricing of a security. So even when I see GameStop go up a lot, I don't think to myself, oh, wow, all these foolish investors, this is just crazy. I don't think that initially. I go back to a quote. This is a Warren Buffett, Benjamin Graham quote. In the short run, the stock market is a voting machine. In the long run, it's a weighing machine. So what you're choosing to do as an index fund investor is not involve yourself in the short-term price action. There are a whole host of folks who have dedicated their lives to ensuring that they take advantage of short-term movements in securities. I'm not one of them, and it's incredibly difficult to do. Very few make a living doing it. Some do, though. What we are in the business of is believing that over the long haul, ownership of companies at fair prices, market prices, and holding them for the long term is going to benefit us the most. So I do hold on to my efficient market theory beliefs while at the same time recognizing, this does just seem absolutely bananas that people would vote with their money in this way. But there's no rule that says this can't last for 2 or 3 years. And what business do you or I have in seeking to get in and out? So the article explains there are actually people shorting the stock, these poor souls. These are people who are betting the stock price would go lower. So they're borrowing shares and hoping to return them later at a lower price. That's how shorting works. These guys just get hit by a train, and it doesn't feel like it's their fault at all. But hold on to your efficient market theory beliefs. Don't look at an article like this and say, it's broken. The pricing is broken. No, it's not broken. It is the case that someone can get on a screen and convince other followers to buy up a security. Don't worry. Over the long haul, holding your index will be just fine. And then in our final article, we talk about 529 plans. Now, many of you may be familiar with 529 plans. As a review, 529 plans are a state-level plan that allows for college savings, although, yes, they now allow you can use them for up to $10,000 a year for a private school, but primarily and historically, they've been used for college savings. The benefit being for those in various states with state income taxes, you get a deduction on the front end. And then if you live in Texas, where we don't have a state income tax, you actually get to grow your money tax deferred. And if you pull it out for a qualified educational expense, you don't pay tax on the withdrawal. So you're for Texans, you're putting in post-tax dollars into this vehicle. It can grow presumably for 18 years. Then when you pull it out for these qualified educational expenses, you don't pay taxes. All good. Well, wouldn't you know it, the government folks keep tweaking this thing, and I wish they wouldn't. Even when they even when they say it's for your good, I think the more they make these vehicles complex, it's just burdensome for the users to actually figure out what the rules are. It requires hourly financial advisor to explain it to people how it works. I think that's sadly how complicated it's gotten. Well, what's new? Well, as a review, there are some helpful changes. So they now have this new Roth IRA rollover rule. So as of 2024, this year, families can roll over unused 529 plan funds to that account beneficiary's Roth IRA. And that doesn't trigger an income tax or a penalty so long as the 529 has been open for at least 15 years. So that you see, they don't want you just to throw a bunch of money in a 529 and pump it out to the beneficiary. But occasionally I will have folks say, well, what happens if my kid doesn't need the money or there's too much in it? Well, you can now take a little bit out. I think it's up to $35,000 can go from a 529 into a Roth if it's open for 15 years, and all the Roth rules still apply. So that's something. Each year, the amount you can give without eating into your lifetime estate tax exemption goes up. So this article is explaining that there are now higher maximum contribution limits because parents can now gift up to $18,000, jointly $36,000 to a child and a child's 529. So either or for 2024. So that's up from $17,000 in 2023. Now they don't have to gift that to the 529, but you certainly can. So that means you can do more. Now that doesn't have to just be your child. So that can be to a nephew or niece or a friend's kid or anyone else. So this now allows for something called a larger super fund. So you can contribute up to $180,000 in a year by super funding a 529 account. That means you're kind of lumping 5 years worth of contributions into this one gift to the 529. I mean, you can't do that every year. You can do it 1 year in a 5-year period and just kind of saying, hey, I'm going to do it one time. That also would not eat into that lifetime gift tax exemption amount. And so great, that's bigger. So in 2024, admittedly, that's a big number for most folks, but that's available to you. And they changed a little bit of the loophole in the grandparent rules. So when people are thinking about college aid, it used to be that grandparent-owned 529 plans. There were various rules that said, hey, look, if your grandparents distribute money to the child from the 529, it's somehow going to count against you. Well, that penalty goes away in 2024. So I guess this is the FAFSA. This is free application for federal student aid, trying to not penalize a kid for their grandparents having funds that contribute. Hopefully that helps some folks. But that's it. My rule on 529s is don't fund it until everything else is spoken for. And I actually don't like people sacrificing for 529 plans. I think there are a whole host of other things you can do, but it can be a nice vehicle long term. So as always, keep that cost low, keep that investing simple, keep that time horizon long, because that's what's going to give you the best shot on your investing journey. Until next time.